Good afternoon. On behalf of the CERS Investment Committee, I'd like to call this special meeting to order. I'd like to begin with the opening statement, please.
Okay. This is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If the connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sherry, would you please take the roll?
Yes, sir. Dr. Hackbart,
Here?
Mr. Cheatham,
Here.
Dr. Milkman, Mr. O'Meara,
Here.
and Mr. McGraw. Thank you.
Sherry, if I understand, we do not have any public comments. Is that correct?
That is correct, sir.
Thank you. This is a special meeting to consider and discuss a recommendation of the staff regarding a real return investment option. So without any further comment, I'd like to turn it over to Steve and to make that presentation. Please proceed.
All right, thank you, Dr. Hackbart. I want to thank everyone for their time today, especially on such short notice. We greatly appreciate this opportunity to present this real return investment recommendation to the committee. And as I mentioned yesterday in the K meeting, I really also want to thank Sherry and Sandy for going above and beyond as usual to coordinate these meetings in a very tight time frame. We put a lot of pressure on them and they always get it done, so certainly appreciate that work. One page forward, please, Sherry. In October last year, the investment committee approved and the board ratified the recommendation to roll a portion of the plan's investment in the Kayne Anderson Energy Fund 7, which was a 2015 vintage fund, into the Kraken Resources Continuation Fund. As we discussed at the time, we were very interested in increasing our investment in the strategy, but unfortunately there wasn't any available capacity as the fund was already oversubscribed. So we just were able to roll our existing exposure. And following that approval in October, we have continued our due diligence process with Kayne team, the strategy. We've worked with internal and external legal, as well as conducted several additional reference calls with investors. And we're excited to present this opportunity today. Staff believes several characteristics of this fund and this Kayne strategy make this investment opportunity so compelling, especially in the real return space. These characteristics include what's really a differentiated strategy. Anthony will touch on that a little bit, but it's a differentiated strategy for the space with favorable expected risk-adjusted return and an asymmetric upside potential. It has a low return correlation to the current real return investments and the broader overall public and private portfolio. The strategy's significant distribution yield profile allows the investment to materially de-risk over short time frames while providing high levels of current income. It also has a shorter funding window, so a significant portion of the capital committed will be called relatively quickly. As we're aware, for any private investment, whether private equity, private credit, or some of these real return or real estate investments, it can take several quarters to several years to fully call capital. So we're excited that this opportunity will call capital and be invested relatively quickly for the systems. As we've discussed several times, the real return asset class is a very broad landscape and includes a wide range of potential investments and strategies. And you can see on the pie chart on the right there, our goal in this asset class is to construct what we consider a robust, well-diversified portfolio across a number of differentiated assets and exposures. Currently, the CRS portfolios are 150 to 140 basis point underweight to their real return targets on an invested basis. We can see that on the left with real return at 5.6%. And this is for the CERS pension portfolio as a representative. If you go to the next page, Sherry. So the graph on the right shows the pro forma allocation of the real return portfolio when all capital that has been committed, including this investment, has been called and invested by managers. Fully called, the total real return allocation, looking at today's valuations, would be approximately 8%, so slightly above the target. But I would note that that includes about 65 basis points. It's going to vary by portfolio that's in the Prisma account, which is tied up in litigation and essentially is held in cash. So we're either looking at, depending on the outcome of the case, we might reclassify that into encumbered assets in our core cash portfolio. It's not really a real return investment. It's just kind of been stuck there. Also, about 25 basis points of that fully called real return allocation represented there is in very small runoff strategies that are paying out and represent a very small exposure. So we're targeting something that's on an invested basis would be right at the target. So with that, I'll turn it over to Anthony.
Yes, thanks everybody. We can go to the next page here, please, Sherry. Thanks. And so you can see the chart there shows what Steve was talking about in terms of a relatively quick distribution of cash. The Kraken continuation vehicle was closed on November last year, and the amount that we were able to roll from Fund 7 was about $17 million in total, and we've received already about 13 to 14% of that cost back through 2 distributions. So the proposal for the recommendation that we have here is for to be in Fund 3, which follows a similar strategy, basically finding assets that are already producing, but then also, like Steve said, have some potential to have some upside through development if additional drilling and exploration is warranted. And so these are assets that they're not like, they won't have the venture-ish profile that we had in the original energy funds from 2015 that our predecessors did. That was much more, exploratory, and it's kind of a model from the mid 2010s where folks, backed teams and they went out and found acreage, tried to prove it up, and then sell that off. This is much more of an approach where you're finding assets that are already productive. Obviously, different technologies have come in and they can perhaps develop it further or produce and then generate cash flow in the way that de-risks things. So, or also just funds continued development. So the continued cash flow gives the managers and the teams that the Kane is backing a lot of options. So that's something that's pretty attractive to us. And so in terms of major risks, I think commodity price is a big one, of course, because it's oil and gas focused. So to mitigate that volatility, they hedge the production out 3 to 5 years, about 70 to 80% of it. So that is something that they have been doing since the beginning of the strategy back in 2013, 2014. And so the Kraken continuation vehicle was exposure we were interested in because we wanted to get to know how the team was doing. And even though it's a strategy that we've kind of followed or looked at, since we got into the original other Kane strategy. But this is now that they've now that Danny's team has taken over all of Kane's energy private equity, this is a chance to kind of see what they were doing and get to know it better. And we like what we found, and that's part of why we're recommending it. And so happy to take any questions, or if Steve has other comments on it.
Yeah, I would add in Anthony's memo and his comments there, two of the clarifications I would make is, so we obviously invested with Kane previously, the prior team here at KPPA did. And you probably note that those investments were part of the private equity portfolio. And again, that was a different strategy than the strategy that they currently employ. Obviously, the fund's names changed too. It's more of an income focused strategy. And as Anthony mentioned, it's less venture and growth oriented. And specifically, that's part of the strategy, as Anthony mentioned, of hedging 70-80% of production, 5-year rolling basis, lowers volatility, lowers exposure to the volatile commodities markets. And it's a differentiated strategy, and that's why our view it's part of we would consider it part of a real return portfolio and not a private equity portfolio where the original investments with the Kane funds were.
Well, if I understand correctly from the presentation we had the other day, the break-even point on the oil and gas industry is around $60 a barrel. And it seems like the price now is hovering more in the 50 range. So it raises a little concern in terms of with the world events taking place, the Middle East increasing production, whether or not this is something we ought to take a hard look at right now. As I understand, this is the Bakken Basin, and that's been in production for a while. Looking into it in terms of some of the economics and production side, it's sort of leveled off. There's very minimal drilling taking place. And so in fact, we'd be investing in wells which have already produced, which means they probably need to be retrofitted or possibly additional drilling and so forth to maintain production. In our conversation, if I understood right, they're not in the drilling industry. They're more in basically acquiring existing producing assets. So I think in terms of they may not be as price sensitive as if this were strictly a drilling operation, because they're under production. Of course, they'll basically have to cover variable costs. But I'm a little concerned about the future in that particular area, about whether or not the pricing structure for that industry is very attractive right now. With the Middle East continually varying their production levels, that's going to affect domestic prices as well. Of course, now we have the whole tariff issue, which we don't really understand the impact that's going to have on industries like this. And in the discussion the other day, it was more about the mechanics of the investment versus the future of that industry, which I think is important when we're looking at investing in a specific area like this one. I was wondering what your thoughts are about that future of the industry as opposed just to as how this would fit in our portfolio.
I think that we've looked. I think the Energy Information Administration has energy usage projections over long terms, and the use of oil and gas is not going to go down in any significant way over the next at least 20 years, probably for much beyond the investment period of this investment. It's also not specifically the Bakken, that's just the Kraken asset. So they will have teams in different areas in the United States focused on finding assets in those different areas. So the 4 Point Energy one that is already in the portfolio as well is in Utah. So it's going to be in different areas across the country. In terms of for macro, I mean, right now, as we were saying, it's hedged. So the fund right now, I think that they told us they're hedged in the 70s right now for production. So out for a few years. So in terms of volatility for in the near term, it's not an issue. But again, the rolling hedging is part of the program, part of the strategy. So, but yes, obviously, it's the volatility definitely makes headlines and can cause some pause. But I think that that's something that they have looked at and are actively addressing. And the break even for some of the productions they have, obviously, it's already producing is a bit lower. I think that if they're able to do add-ons to some of these assets, they're able to reduce some of the costs as well. I think they've underwritten that pretty conservatively. They think that there's savings to have as some of these assets scale, but that's not, I think, their base case. But does that answer the questions, or is there more?
It strikes me as that what in the opportunities are that they would be acquiring assets which are being unloaded by other funds, correct? And these are not new assets; they're existing assets.
They're producing
Some of them have to be-
assets, yeah, and they're often acquired from other from sellers that view them as non-core assets.
That's right.
And if you look, they really are very focused on, if we look at both from a diversification standpoint, as Anthony mentioned, they're broadly diversified geographically. In fact, that's kind of, when we talk to them on the call, part of their is both from a management team, right? They partner with management teams and they look at opportunities in regions. And so the thesis here is that they're going to get assets priced appropriately, priced assets. So really they want to get assets at the right price, that are producing, that have they're in the drilling business, but they're not in the exploration business necessarily, I would say. So that it's more their production focused, then they hedge that exposure. And if you look at, as Anthony meant, they underwrite and model expected returns on the portfolio And what we have in here is, their base case. That's not our expectation. We've actually more conservative for how we position this from an expectation standpoint on a return basis and on a cash yield basis. So I think that you're right. There's some exposure to the volatility of commodity prices, oil and gas. As Anthony mentioned, they hedge out 70-80% of the production, and that's a rolling 5-year hedge. So it's continuously being updated. If they're hedging at lower prices, obviously they're kind of locking in, a lower all-in return for the investment, but they're also mitigating the volatility. So if we look at what we have, or Anthony has in the memo as far as expected return, that's at the lower end of where they were, kind of where they model out and underwrite the assets.
Have you had a chance to review, I guess, Wilshire, maybe we haven't had any observations from them, have we? In terms of their assessment?
We included some consultant reports in the memos that were for trustees. So if you saw them, there were some slides from Kane and then also from a consultant report.
Right. So are there other pension funds investing in?
Yes, the Texas Teachers, Alaska Permanent, state of Utah, state of Michigan, several counties, I think San Bernardino, Fresno. There's several others, but yes, those are among the largest.
I think Dr. Hackford raised certainly a valid point, given where the economy is and what we're dealing with as far as energy pricing. I think it's exactly right. I think I checked oil pricing earlier today and it was down around $58 a barrel. My question or concern, based on what, nobody has a crystal ball. I understand that, but it is all about risk mitigation,
yes,
well as return. And part of that, I don't know. My question is, what have we looked at? I know Wilshire wasn't consulted on this particular investment, but I'm going to direct this question to Wilshire and to Steve and Anthony as well. What did we look at from the investment office standpoint as far as a different asset, not energy versus whatever? My question is, I think what I read through and got back from Wilshire on their one pager, there were some concerns with regard to commodity price and how that was going to be affected. The other concern is the history of continuing these investments out longer than what they were necessarily intended. But my real question comes down to the what other opportunities are there out there at this point in different asset classes compared to energy, and how do they stack up? We looked at that, and I know Wilshire, I think one of the comments I saw back somewhere was there's probably better opportunities in different areas. What are they? And so I don't know who wants to start answering that, but Steve or Chris, you all feel free to jump in.
Mr. Cheatham, to your point, Wilshire is familiar with Kane. We did provide a one-page summary for the Kraken continuation vehicle. I think that's what you're making reference to. I also have one of my colleagues, Mark Freeberg, on the line here, who's kind of more specific into the day-to-day research with these firms and different strategies. He is likely the person that could comment on what other opportunities in this area that we are looking at, because to your point, we have not specifically underwritten this particular fund. Mark, would you like to speak to that?
Yeah, sure. And across real assets, we're looking at a kind of the broad swath of opportunities, and they could range, obviously, from real estate, infrastructure debt, some other categories and strategies that you've seen, whether it's sports related, royalty related. So we've done some things in kind of music royalties. We've done other things in farmland, as well as some kind of esoteric type of strategies within the real return space. On the energy side, while we've done some some work in energy, it's tended probably a bit more towards the equity side, where we're looking for that kind of, if you're going to take that risk within the energy space, we've tended to take it with a little bit more equity. We did look at Kane a while ago when this came out. We did not advance it in our opportunity set, but not because we think poorly of them, or it didn't meet up to an institutional quality. It's just, our focus was really on other areas, and it wasn't something that we were asked to look at specifically.
Jerry, I don't know if you're able to pull it up. Do you have the slide deck from December of 2024 when we did the IT rail one? The other real return strategies reviewed and consideration is on there. So perhaps if you want if you could possibly load that, or else I can try and figure out a way to have that shared. But
that IT is another a good, IT is one that we did, we were positive and like the space. They have a transportation fund as well that we reviewed and have had in the mix in the past.
So again, I guess
this is, I'll read to you if Sherry can't find the slide yet, but it's transportation leasing. We recommended that. Sports was in diligence. That's the NFL fund that was approved by the C plan. Production focused energy, which was this. After that is also energy credit and secondaries. We've had some calls on that. Mining credit is, an area we have exposure to, but it has not been a priority. I think, Alborn did recommend the next iteration of a fund that's a legacy fund here. I'm not as positive on them. Timberland is one that's of interest. Infrastructure is obviously, there's a lot of that. I think that area has been, let's say, bid up a lot. And then commodities is an area that we've also been looking at. So those are some of the things. I think music royalties has been of interest. Like Wilshire said, I'm not sure if they've actually committed, unlike some other consulting folks who have backed some of the other strategies, but that's an area we've looked at. Again, I think speaking to your usual concerns, that is one that I'm not sure about how to exit. I don't think that that's proven or developed. So even though I do like the lack of correlation there, that's not one that we've really followed. I think Wilshire's fans of primary wave. There's obviously several other players out there that do that now. And then let's see, some pharma royalties. We have legacy exposure to that, but that's not an area we've done work on. Obviously, that comes with its own sets of risks. If you guys are, I think energy obviously has its own regulatory and market things, and pharma has as well. So there's a lot of things to look at, and we have definitely considered those. So there, as we've been looking, I think energy is really attractive to us in part because it's where people are not going, right? There's less capital there. So the capital that is going there is more dear. And that tends to be something that we want to do philosophically, right? Where people, if we aren't trying to chase the hot dot, where everybody's just being another check and our capital's not important, in these areas, this stuff is the capital we provide we think can earn a significant return because for the exact reason that people are not in it. And most of the people who did not re-up for Fund 3 are not in this fund for non-economic reasons. The people that we referenced with said, I would like to do it, but the restrictions that they have in their plans, which fortunately we don't, prevent them from doing so. So it's not because they dislike Danny or the strategy, and Danny and Mark or the strategy or Kane. It's more if they have, let's say, institutional restrictions that prevent them from investing.
Yeah, a thesis you've heard from us for a while now is, the under investment in what I would consider more of the traditional energy space. We saw a significant amount of, as Anthony says, chasing the hot dot, capital destruction and kind of that energy transition. A lot of money there went poof, went away and will never come back. We like the space because there's I think all of those peak oil, all the expectation of how quickly we'd be able to transition energy, none of that's going to happen. The time frame is pretty long. We're long-term investors. We feel that this is going to be a space that's going to continue. And again, both from we talk about continuation. Well, the continuation part of it is also look at the cash yield, right? I mean, that's part of the de-risking that goes on with this, specifically with this investment, their strategy and how they restructured. To Mark's point, I agree. On the energy side, why it would be in private equity is if we were taking equity exposure, and that's what we liked it. We like the risk mitigation that's done in this strategy, and it's why it's in real asset, and we wouldn't invest. You know, I'm not so sure we're as interested in energy on the equity side. Yes, there's upside. There was also, that was a lot of work, a lot of capital destruction occurred as well. So I think we like the space, and we like this way of playing the space because the lower volatility, kind of that de-risking, the natural de-risking that occurs in this type of investment. I mean, if you notice that optically, right, it's more structured like a fixed income investment, right? I mean, that's as opposed to equity, and that's one of the reasons we like it.
I mean, just to keep going, they're not on the slide. They would probably be red because I'm super not interested in them. But things I got in my inbox today or yesterday, litigation finance. Obviously, I think we have our own issues with litigation here. So trying to fund people who are doing that is maybe not our favorite. Obviously, not again uncorrelated with the market, but probably not someone we're interested in. Insurance is another one in terms of catastrophes and things like that. So you can imagine the risks that are involved with that, given our flooding or fires and things like that. But the price has hardened over the past few years, and there are managers we know of who have did well last year and claim that they will be going forward. But again, not an area that we've really pursued in great depth. But again, something that we see often and consider. So we're happy to come up with others if you're interested in wanting to know all the things that we look at, either separately or another training or something like that. But yes, there are a lot of things we look at. These are some of them that made it to the page or closer to the top.
You brought up yield, the cash flow. From a comparison standpoint, let's just take this investment and compare it up against, some of our private credit investments. Seems to me like the yield would be comparable, maybe not exactly the same, but pretty comparable. And you don't have, the correlation issue either. Is that what's your thoughts in that area?
I would say that for corporate, well, this yield's higher. I mean, it's levered, so it's higher. But I mean, the other ones are too. But I think the other ones are corporate, and so there's a lot more correlation in that area. So most of our direct lending is going to have that kind of correlation with the general markets, especially obviously public fixed income. It's going to be pretty correlated to that. I think that I would guess that this is probably less correlated, especially as you hedge out the commodity price volatility. So, but this is definitely higher yielding. I mean, the barge leasing is pretty high yielding, and that's a little bit higher than rail car, and I think this is higher than both of those.
Yeah, I would say that the private credit portfolio and especially middle market stuff is going to have a significantly higher correlation to public equities than what we would expect from most of our investments in our real return allocation.
Steve, could you clarify, if I understood your comments, that if we with this commitment and the funds were called, we would be over our 7%.
So yes,
policy?
if looking at it on a full pro rata basis, so that would be again dependent on market values elsewhere in the portfolio. But if as of today everybody called 100%, which as we know most of the time most of our commitments never get called 100%. But if they were, that slide, the second pie charts, Sherry, would have all of the portfolios right around 8%. So a little bit overweight to the 7% target. But the caveat there was about specifically for the CERS pension portfolio, about 65 basis points of that 8%. So is in the Prisma, tied up in litigation, and it's essentially cash. So it's not really a real return investment. The other roughly 25, and again, that's going to vary by portfolio, about 25 basis points is in runoff strategies. So very small exposures where, we've got a couple of tails, some legacy investments in that real return allocation.
Thank you.
So you're talking about like 7.5-ish or so on a target of 7 and your range of 4 to 10. So that's just current, right? Obviously, the issue with if the public markets, continued its drop like it did in early April, then obviously you start to get into denominator issues. But yes, if everything was fully called, so because we're trying to manage liquidity and make sure that this doesn't become a outsized exposure, that's part of why the recommendation was for the amount that we did.
Could you also help me understand why we get ourselves in a situation where we have to make a decision so quickly? We have to call a special meeting and so forth. How long have we known about this opportunity? Is it just in the last few days? Or have we known about it in advance? We just didn't.
We've looked at it for a long time. I mean, we've had we've had different things that we've come to present to you, but yeah, this is near the end of its time.
Yeah, the real timing element of this, unfortunately, is the final close date for the capital commitments. And again, that's I think we can do a better job of coordinating the meetings in advance. Obviously, we got fully through. I think Anthony was still taking reference calls as of early this week. So I think we've been doing legwork with internal and external legal on contract terms. So getting it over the finish line before the drop dead on the commitment date.
Well, I know the original request, that I got was on the 17th of April. So I know at that point in time that it was something that was seriously being looked at. But I certainly got a concern with these things coming up and giving us no time to really investigate and have a real good discussion on what we want to do without it being a drop dead date of today, apparently. But I'm also very concerned as to why our investment advisor was not brought in at a much earlier stage and provided the information so that we could get an opinion out of them. For them to sit there and hear about it from Ed or myself or Dr. Hackler 2-3 days ahead of time, they can't do their due diligence. And I'm
we provide a significant report for you all. It's about 60 pages if you were interested in reading it. I think the smaller, obviously a more summarized version was included in the unredacted memo, but I think the larger report was sent out. And so rather than duplicate work, since we are also paying this other consultant and they are obviously quite familiar with it, having completed operational due diligence and investment due diligence, that's kind of what we went with instead of having to reduplicate things. Plus, like as you said, they had opined on a one pager for Kraken, but obviously a fulsome report and years of updating and a rating, an actual rating, not a this is suitable or whatever. I think that was something that we thought was sufficient or would be effective if
Anthony, you're on mute.
Sorry, I accidentally hit the wrong button. Yeah, we thought that would be helpful in terms of understanding the investment and some of the strengths and the risks, as well as all the diligence points and a lot of history involved as well.
So could you go over, the additional commitment that you're suggesting? But again, it got a little confusing with K and C.
Sure. The K plan has committed to 100, and so their recommendation for this is also 100, because the C plans have a lower target for real return. And so as like we were just discussing, to not be well over your all's target if everything fully funds, we recommended about 100 million, which is about 50 to 60 basis points. So that was the reason for the recommendation here. The K plans are a little bit further from their target. They also have higher targets.
So it would be 100 each K and C, is that correct?
Correct. Mm-hmm.
What I originally saw was 200. Okay.
The thought was, and once we looked at it, we did not want to do something that would cause you guys to be well over target, in case that's not something that you're interested in. So that is what the idea was, to be, you'd be in the 7.5 range, so about 50 basis points above target, excluding the Prisma, if everything was called like immediately, which it won't be, but if it was, to have that.
If C didn't go with this recommendation, I guess K would still do theirs. Is that your assumption?
That's correct.
Yes, that's correct.
Okay. So we wouldn't be impacting them. Okay.
Yeah, now like this continuation vehicle was a weird one because that was out of a private equity fund that both people that was just existing and there wasn't any way to unentangle that. So, but this is separate.
This question is to Wilshire.
Mhm.
Given the market uncertainty that we're operating under right now, of the different asset classes that we had or that we do have, is real return one that we ought to be looking at as far as being, at target or overweighted versus one of the other asset classes?
Yeah, that's a good question, Mr. Cheatham. Given all the volatility we've seen and the uncertainty of what the markets may or may not do based on what this administration plans to put in place, we've been really talking to our clients about staying diversified, really kind of rebalancing back to their targets as we saw volatility in April, being able to lean back in, rebalance to equity. That obviously paid dividends if you were able to do it very quickly. But real return, which in Wilshire's bucketing approach, we tend to look at that as having some inflation protection to it. Inflation is still a risk in institutional portfolios. So making sure that you are at targets is a good approach to take in this case. So we do really want to emphasize that rebalancing and staying diversified is the key in these uncertain times.
Bill, are you on? Or did we lose you in?
I see Bill. I don't know if he can hear us very well or not, though.
Just checking with you, Bill, if you are on, do you have any questions?
He's trying to unmute.
Okay.
There we go.
I'm hearing about 10%. Anything that Mr. Cheatham or Mr. Chu has said is not come clear. So I don't, and I haven't also had access to any of the data that was distributed because I'm out of town. So I don't feel like I'm knowledgeable enough to ask questions or to vote today.
Okay. Any other comments before we see whether there's a motion or not?
I don't have any questions other than what I've asked. I would have
Okay.
liked a
All right.
more thorough look at the overall portfolio and what we're trying to accomplish.
Good. Well, thank you. I guess our time is moving along. Would anyone like to make a motion either in favor or not to recommend this recommendation to the full committee? Not hearing one, I guess we will not be reporting a recommendation to the full CRS committee at the next meeting. Is that everyone's understanding?
I think that's probably a fair guess. I know Bill, as he indicated, hasn't had adequate information or access to information. He's traveling.
Okay.
I still have questions and concerns that I'd like better answers to.
Sure. Okay. If there are any other comments or questions? If not, I think that completes that section of today's agenda. And with that, I think, and I'll just suggest we are adjourned.
We'll see everybody in a few minutes.